All right, so the thumbnail was in fact true. Today, I sold off a large majority of my portfolio during this extreme dip. But before you get all,
This guy considers himself a personal finance expert. No one would sell now.
hear me out, because I did it for a pretty good reason, which might help save you thousands of dollars. So the reason I did this was to take advantage of something called tax loss harvesting. No need to Google it. I'm going to tell you everything that you need to know about tax loss harvesting and why it's something for everyone to consider, but not for everyone to do. I'm going to give you the pros and the cons, tell you why it was right for me, why it might be right for you, and for some people, why you really can't use tax loss harvesting. First, a basic rundown of what I mean when I say tax loss. Right now in your portfolio, you know that it's gone down. It's gone down with this dip. So right now you have a capital gains loss in your portfolio. As opposed to before this, when we were on this extremely awesome run and all of our portfolios were up, if you were to sell, you would have a capital gain. But now at the end of the year, when you pay taxes, you pay the difference or the net capital gain versus capital loss. So for example, if you have a capital gain of say $1,000 at the end of the year, but you also had a capital loss of $1,000 in that year, that would wash out to $0 and you wouldn't have to pay any taxes on those capital gains, right? Because it washed out by the loss. And just like anything with taxes, this can seem like it's something that's so confusing, but it's really not. I did it in under 5 minutes, and with just a little bit of knowledge, you'll know if it's right for you or not. So here's kind of like an overview, pretty generally what I did. I sold off a large majority of my portfolio, and I took a huge capital gain loss on those sales. But this wasn't because I was freaked out about the market. It was because I wanted to get my money back in the market at a lower price and lower my tax basis. Then I'm not taking the money from the sale and putting it in my bank account or buying something with it. What I'm doing is I'm putting it right back in the market in a different fund. And I'm going to talk about like what you can rebuy because there are some rules against that. So at the end of the day, I'm going to have the exact same amount of money invested, but I'll have a huge amount of capital gain losses to wipe out ordinary income on my taxes next year and for years to follow. So here are the basic steps. Step one, go into the appropriate accounts that you have investments in. Essentially, tax loss harvesting is only going to work in taxable accounts, like brokerage accounts. It's not going to work in things like Roth IRAs because those grow tax-free, so you don't pay any taxes on those capital gains. And things like your 401k, those are tax deferred. So as they go up right now, you are not paying taxes on those either. So essentially, this was just my investments inside my taxable accounts. Then I went into that taxable account and I found anything that had taken more than a 10% loss. Now, I just chose 10% because anything less than that is really not worth your time. And right now, that's pretty much everything. For me, you guys know that I'm an index fund investor, so everything that I have is in index funds. So this was really easy to identify. All of my index funds are down 10% or more. And in doing so, I take a capital gains loss of just under $10,000. Now what I'm going to do is I'm going to take all of that money and I'm going to put it into something that performs similarly to what I just sold, but is not the exact same fund. So say a different index. A good example of this is IMN VTSAX. You guys know that. That is the total stock market index fund. I can now switch that money into say an S&P 500 index fund and I'll be fine. Here's the reason why you can't rebuy the same identical mutual fund, bond, or stock. The IRS is pretty hip to us knowing about this and being able to possibly take advantage of it. So they've made a couple rules to help regulate it. And one of them is called the wash sale rule. The wash sale rule states that if you sell an investment for a loss, the loss will be disallowed if you buy that security or one that is substantially identical within a 30-day period before or after the sale date. So if you sold a mutual fund investment for a loss and bought that same fund within a 60-day window, your loss would be disallowed as a write-off. Okay, so this disallows me from like selling all my VTSAX, taking the loss, and then just rebuying it. But like I said, if you use a different mutual fund, these will not wash out. Now, a couple of things to understand about the washout rule. Number one, there's no like list of comparable things. It's pretty much up to your discretion to know that you are not buying something that is substantially identical. The other thing to know is that if you make a mistake, The washout sale is not an illegal practice. So, for example, say you sold one thing and bought another one, and then later on the IRS determined that those were identical. You didn't break any laws. You just won't have that tax loss advantage. So, a very common transaction among long-term index fund investors is to go from the total stock market into the S&P back into the total stock market, and that should be fine. They pretty much perform identically, but they are different funds according to the IRS. An example of a washout rule would be, say you sold a Vanguard total stock market index fund and then went over to, say, Fidelity and bought their total stock market index fund. Those would probably be pretty close to being substantially identical, and you'd probably get that washed out. But say you sold all your Ford stock, but then you went and bought General Motors. Although they're still the same car company, they're very, very different companies, so that wouldn't wash out as well. But they might perform differently. The good thing about using index funds like the total stock market index fund and the S&P 500 is that they pretty much align with their performance. So now that I go into the S&P 500 index fund, what I need to do is I need to wait 60 days, and then I can make a couple determinations. One, if the market still continues to go down, I'm going to sell off my S&P 500 and then go back into VTSAX and take even more losses. So that's a strategy that you can do. And if it goes up, like say tomorrow the stock market just decides to go up and up and up, I'll have the S&P 500 index and I'll hold on to it for as long as I have to until I get another 10% drop. Then I'll sell it and I'll just go right back into VTSAX, and I'll do that for as long as I have to. Now, there are some limits to how much tax loss harvesting you can take advantage of. Right now, that's $3,000 max, but if you have more than that, you can roll it over into subsequent years. For example, I told you I had just under $10,000 worth of losses, so I'll take a $3,000 loss in 2020, considering I don't sell anything for any capital gains. And in the 22% tax bracket, that's going to save me about $660 in taxes at the end of this year. And then I'm going to do the same next year and the same the year after that with those additional losses that I took this year. Now remember, with those following years and the years to come, I can't take any capital gains because this will go and offset those first. But I'm a long-term investor and I'm only going to sell if I'm taking tax loss harvesting, so I don't really need to worry about that particular nuance. So who is this really not right for? Well, like I said, it's not right for people that have a majority of their investments in tax-advantaged accounts like 401ks, Roth IRAs, etc. So this is really only for brokerage account people. It's not for people that haven't taken a huge substantial loss on their funds or their stocks, or people that are just in investing for the dividends. And it's also not great for somebody that falls in that 10 to 15% tax bracket, because for you, capital gains are taxed at 0% anyway. So if you have a really, really low income, then you don't have to worry about doing this at all, because under 15%, you don't pay tax on your capital gains anyway. So although I sold off a majority of my portfolio, I bought right back in, just in a different fund that is not substantially identical to the one I previously had. I'm going to continue to buy more in this dip, and I can't wait until the stock market goes up. I think future millionaires and billionaires are going to be born and made in this crisis time right now. And if you are an investor, stay the course, keep doing what you're doing. Automatic investments every single week, every single month, whatever's best for you. And in the long term, the stock market is going to rebound, it is going to go up, and you will get to take advantage of this opportunity. So click this for more information on my investing strategy, and right down here is my entire Vanguard playlist. I'll give you everything you need to know about what I'm doing. And until I see you guys on the next one, stay positive, work really, really hard, always be kind to other people. I hope you have yourself an amazing day and an even better tomorrow.